Welcome to the Equinox Gold presentation here in September 2020. I'm Christian Milau, CEO of Equinox Gold. Please note the cautionary statements as I will be making forward-looking statements during the presentation. We created Equinox Gold about 2.5 years ago to create the premier America's gold producer. Ross Beaty is our largest shareholder and chairman, and we put 3 companies together in late 2017 and reformed the company and renamed it Equinox Gold. We're really proud of the achievements we've had in those past 2.5 years to get where we are today. And as you can see, we now have 7 operating mines and 3 growth projects in the portfolio. We have a nice spread of assets in the Western US, Mexico, and in Brazil, and almost 12.2 million ounces of gold reserves. And those ounces of reserves and resources are split about 1/3, 1/3, 1/3 in those regions. This year, we'll do about 500,000 ounces of gold production at just under $1,000 all-in sustaining cost. So solid mid-tier gold company, producing gold company. And we have a pathway with our growth projects towards 1 million ounces a year of annual gold production. And the liquidity on the balance sheet is about $500 million, so we have the cash and the revolving credit facility capability to fund all of our growth projects internally. And as you can see, we've had very strong growth, and it's really peer-leading growth over the last few years, going from almost a standing start in 2018 when we acquired Mesquite, which was our first producing asset. We've improved the gold production, mineral reserves, as well as cash flow from operations very substantially in the multi-100% growth increases over that period of time. So through rapid development and growth, partly through M&A, we've really grown the company from that single asset sort of producer status up to a 7-mine producer in less than 2.5 years. And also on the capital markets growth, we've had incredible improvement in terms of our daily liquidity. We've moved from $1 million or $2 million a day in 2017 all the way up to about $50 to $60, $65 million a day of trading on the 2 stock markets where we're listed, both New York and Toronto. And also our shareholder base has been broadened over time. Ross Beaty owns 8%. We have almost half of the stock now owned by long-term institutions. And we still have some high net worth and retail shareholders that have been with us for many years now. And in terms of our growth pipeline, as I mentioned, we have a peer-leading growth pipeline, as you can see on the left-hand side of this chart. We're growing at about 20-25% per year over the next few years with our 3-4 growth development projects. And really, Castle Mountain Phase 1, as you can see on the right-hand side, was the first in the pipeline. We've just completed construction on that. It's now actually operating. It should be pouring gold in October. And the second one in the pipeline really is that green bar, Santa Luz, and that's a restart of a past producing mine. It'll cost us around $100 million to put in production for another 100,000 plus ounces per year of production. And that should be done around the end of 2021, early 2022. The third one in the pipeline is the Los Filos expansion. That should add another roughly 150,000 ounces of production, and that should be in production in 2022. And then Castle Mountain Phase 2, that should add another 150,000 ounces of production. That's a few years out, as we need to do some permit amendments over the next couple of years after Phase 1 is in operations this coming quarter. Looking at the individual assets, starting with Los Filos, the expansion project's already underway. It's currently producing roughly 180,000 ounces a year. It's got expansion potential up towards 350,000 ounces a year over a 10-year life. This asset's gone from being a 1.7 million ounce reserve deposit up to 4.5 million ounces over the last few years. There's also great expansion potential here as well, both exploration on the property, but as well the expansion that's already underway, which is opening up a new open pit and a new underground deposit being Burma Hall, and as well upsizing the actual processing capability from a pure heap leach pad processing facility by adding also a carbon and leach plant, which again will be done probably in mid-2022. So we're really excited about the upscale potential, the long life of this mine, and the potential to increase reserves over time. At the moment, we do have a blockade on site. We're working through that with dialogue with our local communities. We expect to be able to resolve that in due course and get back to normal course operations. Turning to Brazil, in the northeast corner of Brazil, we put Aurizona back into production. It was a past producing mine. It started production in mid 2019. It's about 120 to 30,000 ounces a year of annual production. Has about 1 million ounces in reserve, and we continue to explore this. What we're really excited about here is there's 1,100 square kilometers of exploration concessions, and it's really on an underexplored area. So we have the core deposit of 1 million ounces, then we have underground potential, and we have open pit expansion potential, as well as satellite deposits within about 20 kilometers of the current plant. So we've actually started an exploration program this year. We're upgrading the underground drilling work that has been done historically. There's a PEA study out on that underground indicating about 750,000 ounces of gold. We'll be coming out with another study, being a PFS study, a pre-feasibility study next year on the back of all that drilling work and the updated engineering. So we're excited about this. We think this should be a multi-decade mine, both open pit, underground potential in a very underexplored area with a greenstone belt. Then turning to California, Mesquite, we bought this in late 2018 for just over $150 million. It produces about 130 to 40,000 ounces a year. It's been going for about the last 30 years on and off, and it's a real steady state producer. We bought this with a 3-year mine life with another sort of maybe 3 or 4 years of residual heap leach potential. So the interesting part here was we paid about $150 million when gold price was $1,200 an ounce. We're 2.5 years into mining out that deposit. We still have another 3 years of mine life left. Exploration has been really successful at this site. We've allocated dollars to extend that life, and we've been basically drilling off old waste dumps, leach pads, and as well as a bit of in situ gold to add to the reserve base. So the upside potential here may not be quite as extensive as at Aurizona, but we can keep incrementally adding a year or two to the actual mine life. And interestingly, there's also some new concessions we have across the highway to the east that look like that potentially the ore body could extend underneath that highway, and there's potential to go and drill there and maybe move the highway in due course, which has moved once in the past. So we like this asset. It's currently producing and generating a lot of cash flow in the business and is outperforming expectations, and we like the upside potential. Look at the other assets in the Americas. Fazenda in Brazil, a slightly smaller producer at 75,000 ounces a year. It's been going on and off again since the 1990s, so it's got a long track record of success. This year, for the partial year since ownership, when we bought Leagold, it'll produce about 55,000 ounces. It's currently producing gold at roughly $900 an ounce, all in sustaining cost. So a nice steady state producer in Bahia State, about 100 kilometers away from Santa Luz. Then there's RDM in Brazil. This is in Minas Gerais. Again, similar size to Fazenda, but an open pit operation. It's been producing since 2014, producing gold at just slightly higher costs than Fazenda, but it's been actually one of our best performers recently, and we're really pleased with its performance. We've just received a pit extension permit, which will allow us to access higher grade ores as we move forward as well. So this one's a nice little producer within the portfolio in Brazil. And then Pilar, being the smallest asset in the portfolio, on average produces about 40,000 ounces a year. It's been producing nicely in this period of weak currencies in Brazil and high gold prices, producing a nice margin. We will consider at some point maybe selling this asset, but at this stage it's contributing nice cash flow to the business. Now turning to our projects and the growth project, which is quite exciting. These are the key catalysts coming up here during the next sort of 3 months to give or take a year from now. Castle Mountain, as we mentioned, is just going into production. We just finished the physical construction and $60 million of capital spend in California. It's about a 4-hour drive north of Mesquite. It will actually ship loaded carbon on trucks a couple times a month at least down to Mesquite. We're going to smelt all the gold bars there and actually share in the capital, share in the people, the systems, maybe even some of the equipment in due course. So some real synergies between these two mines, and you'll also be able to tax consolidate them. This is a big deposit, 3.6 million ounces, 16-year life. We're really excited about the potential long-term for this asset. So we have a 45,000 ounce producer, which is phase 1, which has the potential to go for, give or take, 10 years right now. And what we're going to do on the back of getting into production here next quarter is actually finish off the feasibility study, which will upgrade the cost estimates and the economics for phase 2, which can take us up to 200,000 ounces a year of annual production. What we'll do as well on the back of getting that feasibility study out around year end is look to amend the permit. So stay within our normal or our already permitted EIS boundary, but look to increase the area disturbance in due course so we could potentially upgrade this to a 200,000 ounce producer. And there's lots of upside potential around this project as well. Turning back to Brazil, and as we mentioned, about 100 kilometers away from Fazenda in Bahia State is Santa Luz. We have a restart plan in place. This is a mine that was built around the period of 2008, I believe, when Yamana owned it. It has 11-year mine life, over 1 million ounces in reserve, and will produce on average about 100,000 ounces a year. So for a modest amount of capital of about $100 million, we'll be able to put this back into production and basically look to extend the mine life through further exploration, both open pit and underground. So there's a lot of similarities to Aurizona, where we see this as a long-term core asset in the portfolio. And again, we're going to look at the district scale potential because Fazenda and Santa Luz are within 100 kilometers of each other, and there are various exploration permits that are between the two of them. And in order to fund the growth capital and expansion potential, we have a strong balance sheet at the moment. So we have about 300 million of cash on the balance sheet. We'd repaid about $200 million of the revolver, the corporate revolver, a few weeks ago. So overall, we have over $500 million in liquidity. And when you look at our overall bank debt, total bank debt of about 300 million and our cash on hand of over 300 million, we're about net debt neutral or cash positive almost at this stage. So the balance sheet's really strengthened in the last 6 months. We also have an in-the-money convertible note, which is 100% owned by Mubadala, which is one of our core long-term supporters. They are the sovereign wealth fund of Abu Dhabi. And the conversion and strike price on that is effectively $6.50 US. So our current stock price is closer to $12. So we view that as almost equity, and they're long-term partners alongside Ross Beaty to help grow this business into a good-sized gold mining company. And one of the key aspects and areas that I'm really excited about is when we set out to build this company, we wanted to do it in the right way. You know, this sector is cyclical. During the last run up in the sort of mid 2000s, there around 2008, 9, 10, 11, you know, I think there was some abuse of executive pay and payouts which weren't aligned with shareholders and for performance. So what we've done is we've really looked to have insider ownership as a cornerstone of this business. So Ross owns about 8%, being our chairman. He's very active in the business. We have a very regular dialogue. Management owns most of the rest of that, 0.5%. We've all put in, you know, multiples of our salary. I've got about 10 times my salary in this company invested right now. And when you look at that overall 8.5% ownership, it's at the top end of our peer range for those mid-tier to larger gold mining companies. So it really puts us, we really stand out versus peers in that sense. And in terms of the incentive side of things, you know, our pay is linked to performance. We have performance share units and RSUs that are actually only paid out over time, and the PSUs are only paid out if we perform and meet certain predefined objectives versus our peers and versus objectives that we set for the business. And our corporate G&A is one of the lowest in the sector at about below $50 per ounce, so we're very proud of that. And then when we look at the valuation side of things, you know, in 2021, the expectation is over 700,000 ounces of gold production. We're doing just over 500 or around 500,000 ounces this year. And when you translate that into a valuation, you know, the intermediate average for enterprise value to resource is below $200 an ounce. But as you can see, we're almost at about half that level. So we really have some work to do here over the next 6, 12, 18 months to continue to climb up that valuation curve as we get a re-rating and prove to the market that we are close to a 1 million ounce producer on a more steady basis. And then when you look at the price to net asset value, again, a lot of our peers are trading in that 1.5 times range, and the intermediate average is over 1 times. We're currently trading on about 0.8 times. So again, as we execute on our growth strategy and we actually deliver on the capital programs that we have in place, we expect to continue to get a re-rating in the sector. And this graph just shows it a little bit differently. As you see on the left-hand side is the price to net asset value ratio. Along the bottom end is the actual production estimates based on analyst consensus for the next year. And you can see Equinox is moving from the left to the right as we move up the production profile towards 750,000 ounces and then ultimately eventually towards 1 million ounces a year. And as you can see, our peers, the market cap is indicated by the bubble size. A number of our peers towards the top right of this graph have larger bubbles, sort of in that $6 billion to $10 billion market cap range, and tend to trade on a 1 to 1.5, maybe even up to a 2 times price to net asset value multiple. We're slowly moving in that direction, as you can see, towards the right. And as we deliver on our growth profile, we certainly expect to move up and see really strong potential to grow the valuation and get a re-rating of this company. And for this year, we just want to summarize by highlighting the key catalysts going forward. Again, we have a fully funded growth platform. 2020 had a lot of catalysts. Operations and development, we have various expansion projects that are just getting underway. Los Filos expansion has just commenced. The CIL construction will not start until probably early in the new year, but we're just finishing off a study to indicate the size of that plant, likely to be 8,000 tons per day, and the capex and the economics on the back of that. Santa Luz construction restart. We've actually started early construction works there. We expect official construction to start in Q4. We'll be putting out a new feasibility study, which will indicate the economics for that, but that's going to be a very exciting project. Should be up and running and pouring gold, around the end of 2021, early 2022. Castle Mountain Phase 1, we expect to pour gold in Q4, so that's imminent. Castle Mountain Phase 2, we expect to get the feasibility study out in around the end of Q4, early Q1, which will indicate the economics for Phase 2, which will be the exciting project that can produce 200,000 ounces a year in the western US. And also we're commencing the Aurizona underground pre-feasibility studies we mentioned. On the flip side of that, in addition to our development projects, we're also going to be starting a 3-year exploration review. So what can we do to extend the mine life? And we really believe we can add value at most of our assets through the exploration drill bit. We will be allocating some capital to that, but we're going through that exercise right now as we have just finished integrating both Leagold and Equinox Gold assets into one platform. And we expect to also be very specifically upgrading the Aurizona underground resources. And corporately, it's been an ambitious agenda, and we've achieved certain things this year. We've completed the Leagold merger and integration. We've been included in various indices, GDX, GDXJ, also the S&P TSX composites. And as well, we've started sustainability reporting on our website, and ESG will be a big focus for us as we move forward here and combine the two companies and really get our baseline data together, start with better communications, more frequent communications with our shareholders and with the investment world, as well as other outside stakeholders. And then, as I mentioned earlier, one of the key objectives over the next 6 to 12 months is to continue to push for that re-rating and be rated on a similar level in terms of valuation to our peers that are sort of a 750,000 ounce plus ounce producers per year. And I think with that increased scale and diversity and execution on our growth platform, we really will deserve that re-rating. And then, our focus will be mostly on internal growth, but we're also going to be keeping our eye on the market. If there's accretive M&A, we've shown, I think, a good track record over the last 2.5 years of acquiring assets that are accretive, that can actually enhance the portfolio, diversify the risk, and also bring value to shareholders over time. So that's a good quick summary of Equinox Gold. We're creating the premier America's gold producer, and it's going to be an exciting ride over the next 12, 18, 24 months as we deliver on the growth projects, get a re-rating, and continue to deliver on the story that we set up about 2.5 years ago. Thanks again today for joining us, and please feel free to reach out with any questions at any time. Thank you.